Imagine a quiet revolution in one of the world's most trusted corporate empires. It all began in the late 1800s in a modest building in New Brunswick, New Jersey. Two brothers, Robert Wood Johnson and James Wood Johnson, along with their friend Fred Bates Kilmer, started a small family business. They focused on producing sterile surgical dressings and safe medical supplies that could prevent infections and save lives during an era when surgery often led to deadly complications. This was Johnson & Johnson, founded in 1886, and from those humble beginnings, it grew into a global healthcare powerhouse built on trust, innovation, and reliability. The early years were defined by a commitment to quality that set the company apart. Robert Wood Johnson, inspired by Joseph Lister's work on antiseptics, insisted on using the most advanced sterilization methods available. The company pioneered ready-to-use sterile bandages and gauze, products that dramatically reduced infection rates in hospitals and on battlefields. During World War I, Johnson & Johnson supplied massive quantities of surgical supplies to Allied forces, cementing its reputation as a reliable partner in times of crisis. After the war, the company continued to innovate, launching products like Band-Aid adhesive bandages in 1920. Invented by an employee named Earl Dixon to help his wife with minor kitchen cuts. This simple yet ingenious item became an instant household essential, symbolizing the company's ability to blend practicality with everyday care. The company also established enduring principles early on. In 1943, it adopted one of the first corporate credos in American business history, a document that explicitly placed responsibility to patients, doctors, nurses, mothers, and communities first before shareholders or profits. This ethos guided decisions through economic downturns, wars, product recalls, and global expansions, helping build loyalty that spanned generations. Over the following decades, the company expanded carefully but boldly. It introduced iconic products that became household names: Johnson's baby powder for gentle infant care in the early 1900s, Tylenol for pain relief in the 1950s after acquiring McNeil Laboratories, and Neutrogena skincare through later acquisitions. People trusted the Red Cross logo because the company prioritized safety and quality above all. But Johnson & Johnson did not limit itself to everyday consumer items. It ventured into advanced medical devices, creating surgical tools, orthopedic implants, cardiovascular stents, and equipment that helped doctors perform complex procedures with greater precision. At the same time, it built a powerful pharmaceuticals division, developing prescription drugs to treat serious conditions like cancer, rheumatoid arthritis, immune disorders, cardiovascular diseases, and infectious diseases. Key milestones marked this growth. The acquisition of Janssen Pharmaceutica in 1961 brought expertise in psychiatric and neurological drugs, leading to breakthroughs like Risperdal and later Remicade for autoimmune conditions. In devices, the Dupuis acquisition strengthened orthopedics, while Ethicon advanced surgical sutures and These three pillars, consumer health, medical devices, MedTech, and innovative medicines, formed the core of the empire. For more than a century, this diversified structure proved brilliant. The reliable cash flow from stable consumer products, such as bandages, over-the-counter painkillers, skincare items, and oral care, provided a steady foundation. This money funded the expensive, high-risk research needed to discover and test new breakthrough drugs, where failure rates were high but successes could generate billions. The MedTech business offered solid margins with predictable demand from hospitals and surgeons worldwide. The pharmaceutical arm delivered explosive growth whenever a new therapy succeeded, often turning into blockbuster products worth tens of billions in cumulative sales over their patent lives. It was a natural hedge. When one area faced challenges like patent expirations on older drugs reducing revenue, regulatory delays for new devices, or competitive pressures in consumer markets that others balanced it out. The company became synonymous with healthcare stability, growing into one of the largest corporations on earth, consistently ranking among the most valuable, with a market value soaring into the hundreds of billions and a reputation for consistent dividends that rewarded patient long-term shareholders. Generations of families grew up using its products, from baby shampoo to first aid kits, while doctors relied on its innovations in operating rooms and pharmacies dispensed its life-changing medicines. Yet by the early 2020s, subtle shifts began to challenge this long successful model. Global markets evolved rapidly, influenced by low interest rates, technological disruption, and a new generation of investors focused on efficiency and specialization. Wall Street increasingly preferred clear, focused stories over broad mixes. A single company blending slow-growing defensive consumer goods with high-volatility pharmaceuticals and capital-intensive devices created confusion and valuation. Investors interested in rapid innovation and high multiples gravitated toward pure-play pharma firms like those dominating oncology or immunology. Those seeking safety and reliable payouts preferred standalone consumer health businesses with predictable cash flows. Adding to the complexity were ongoing legal battles, particularly thousands of lawsuits related to talc-based baby powder and claims of links to ovarian cancer, which introduced prolonged uncertainty and potential multi-billion-dollar liabilities that weighed on the entire enterprise's perception and stock price. Markets often apply a conglomerate discount, To such diversified giants, they pay less because the parts are harder to assess individually, with risks and growth rates pulling in different directions. Analysts estimated that billions in potential shareholder value remained trapped inside the mixed structure, as the whole was valued less than the sum of specialized parts might command. Activist investors began acquiring shares and quietly pressing for action through private discussions and public letters. Financial analysts openly discussed unlocking value through separation, pointing to successful precedents in other industries where spin-offs led to higher combined valuations. The idea gained traction. Spin off the consumer health division to let it operate independently as a stable, dividend-focused entity, appealing to income-oriented funds, while the remaining company sharpened its edge in higher growth areas like oncology drugs, immunology, therapies, advanced surgical robotics, and next-generation medical technologies. Leadership. Under CEO Joaquin Duato, who took over in 2022, faced a tough but calculated decision. Tradition ran deep. The consumer brands had built the company's fame and trust for over a century, and many inside the organization saw them as the emotional heart of Johnson & Johnson. But the strategic logic was compelling and dated. A split would isolate risks better. Litigation or market slowdowns in consumer products would no longer drag down the high-margin pharma and MedTech engines. It would allow sharper capital allocation, more resources poured into R&D for next-generation medicines and cutting-edge devices, with dedicated management teams free from divided priorities. Most importantly, pure-play companies frequently trade at higher valuation multiples because investors reward specialization, transparency, and clear growth narratives without the drag of unrelated segments. In November 2021, Johnson & Johnson made the announcement that shocked many observers. It would separate its consumer health business. The process unfolded over the next 2 years with meticulous planning to minimize disruption. The new entity, named Kenvue, blend suggesting Ken for knowledge and Vue for vision, was carved out carefully. It went public in May 2023 through one of the largest initial public offerings in recent history, initially valued in the $40 to $50 billion range, drawing strong interest from institutional investors seeking defensive healthcare exposure. Johnson & Johnson retained a majority stake initially to ensure a smooth transition. Then, in August 2023, it completed the full separation via a tax-efficient exchange offer, allowing shareholders to swap J&J shares for Kenvue shares. By the end, Johnson & Johnson had divested almost entirely, keeping only a minimal position before fully exiting, marking the cleanest possible break. The immediate effects were profound and multifaceted. The remaining Johnson & Johnson streamlined into 2 focused segments: innovative medicine pharmaceuticals and MedTech medical devices. Freed from the slower consumer side, it could chase aggressive growth in high-margin areas. Key drugs like Darzalex for multiple myeloma continued to expand indications. Tremfya for psoriasis and beyond showed strong uptake, and newer launches such as Carvykti, a CAR-T therapy for cancer, and Tecvayli began scaling rapidly. MedTech, innovations in surgical robotics, cardiovascular interventions, vision correction, and wound care advanced steadily. Short-term challenges during the transition were real. Untangling shared supply chains across continents, separating IT infrastructure and data systems, reallocating thousands of employees, and rebuilding administrative functions cost hundreds of millions in one-time expenses. Brand identities needed redefinition. People had long seen everything under one trusted umbrella, and marketing teams worked to preserve equity while establishing distinct identities. Yet these were temporary pains for long-term gains. Clarity improved dramatically across operations, strategy, and investor communications. Balance sheets strengthened with cleaner risk profiles. Investor confidence grew as the market rewarded the focused narrative with higher multiples on earnings and growth prospects. Fast forward to early 2026, and the results tell a compelling story of successful execution. In its fourth quarter and full year 2025 earnings, released in January 2026, Johnson & Johnson reported full-year sales of approximately $94.2 billion, with operational growth of about 5.3% and adjusted operational growth of 4.2%. Adjusted earnings per share reached $10.79, and the company delivered a strong Q4 with reported sales up 9.1% to $24.6 billion. CEO Joaquin Duato called 2025 a catapult year, fueled by the strongest portfolio and pipeline in the company's history, emphasizing leadership in oncology, immunology, neuroscience, cardiovascular surgery, and vision. For 2026, guidance projected reported sales around $100.5 billion, midpoint growth of 6.7%, and adjusted EPS in the $11.43 to $11.63 range, beating many expectations despite headwinds like drug pricing pressures and potential tariffs. The pipeline showed promise with potential approvals and submissions for drugs like Tremfya and new indications, Darzalex expansions in multiple myeloma, Tecvayli in earlier lines, and nipocalimab in autoimmune conditions. Oncology remained a key growth driver, with ongoing advancements in blood cancers and solid tumors. The stock responded powerfully to this clarity and performance. As of mid-February 2026, shares traded around $243 to $244, pushing the market capitalization to approximately $586 to $587 billion. This represented substantial gains from earlier levels, reflecting renewed faith in the streamlined company's robust pipeline, improving margins and ability to navigate challenges like biosimilar competition and policy shifts. The separation had unlocked trapped value by allowing each former part to attract the right investors and strategic focus. Kenvue, meanwhile, charted its own independent path as a pure consumer health player with beloved brands like Tylenol, Neutrogena, Listerine, Band-Aid, and Johnson's Baby. It aimed for steady dividends and defensive appeal in uncertain markets, though it faced pressures from softer demand in some categories, currency fluctuations, and lingering legal overhangs from the talc era. Its stock traded around $18.70 in mid-February 2026, with analysts noting potential upside if organic growth stabilizes. Looking back, the 2023 separation was no sign of weakness or retreat. It was a deliberate, forward-thinking restructuring, a masterstroke of capital strategy in an era where markets punish complexity, reward focus and transparency, and demand efficient allocation of resources. The old diversified empire did not fade or diminish in total value. It evolved into sharper, more valuable entities that together commanded greater respect and higher combined worth from investors. This move mirrored broader trends across industries, where conglomerates increasingly face activist pressure and shareholder demands to divide for efficiency and unlock hidden premiums. In healthcare specifically, specialization has become a competitive edge, allowing companies to attract top talent, accelerate innovation, and respond faster to scientific advances. The separation also highlighted the power of strategic patience. By isolating consumer health into Kenvue, Johnson & Johnson could double down on high innovation areas without the drag of slower growth segments. This refocus enabled bolder investments in emerging technologies like cell therapies, bispecific antibodies, and advanced robotics, positioning the company for sustained leadership in transformative medicine. Johnson & Johnson's story reminds us that, in the relentless game of corporate finance and power, bold separation can sometimes build greater strength and longevity than endless expansion or clinging to tradition. The dynasty endures not as one sprawling kingdom burdened by mixed narratives, but as precision-focused leaders unlocking billions in renewed potential through clarity and purpose. In a world of rapid technological change, regulatory shifts, and investor scrutiny, specialization and strategic focus often prove the ultimate advantages. The quiet revolution continues, reshaping not just one company but the future landscape of global healthcare giants and how they create and capture value for shareholders, patients, and society in the decades ahead.